Hello guys, welcome to the Solid as a Stock session. Hopefully it's obvious what market we're going to... now I know you guys can't see me today, I don't have my camera, but hopefully you can still hear me fine and the session works well. So just let me know on the chat box if you can hear me. If you're there, let me know if you're on the chat, say hello. And as always with these kind of sessions guys, if there's any market in particular you want me to look at, any questions that you have, anything that you want me to go over, by all means please just put it in the chat box. I'm always happy to look at what you guys want me to look at and explain what you guys need me to explain. So before we start, let's just make sure we cover the disclaimers, get that done. So they are being highlighted there at the top of the screen. Of course, important for legal reasons that you read them, but also to understand that these kind of videos are demonstrations. So I'll show you what we do and how we do it. You can of course ignore it, you can take it on board, something in between, ultimately up to you to decide what works best as a individual trader. Now my name's Becky. Normally my face is in the way, but you can see it today. My name and my email address, becky@tradictive.com is my email address there. I know it's on its side, but hopefully relatively easy to read. There's also this link here, tradewithufos.com/Becky. I'll take you to that real quick. This link I would prefer you come to, just because once you're here, you can set up a free Trade with UFOs membership, and then you can come down and ask questions in a public area, which means I can answer questions in a public area, and everybody learns together, and everybody can see the answers. So I prefer it if you do that, but you can email me if you would prefer. So I've just seen a message there from Christian. So hi Christian, thanks for joining us today. Again, let me know on the chat box, Christian, if there's any particular stocks you want me to look at or anything in particular you want me to go through. Okay, so that's tradewithufos.com/Becky. Now let me just explain for those that might be watching new how we do these sessions. So first of all, we say hello, so that's done, check that off. The next thing we need to understand is that we are simulcasting or simulcasting, never sure how to pronounce that. Simulcasting means that we are streaming in different places at the same time. So we're streaming on YouTube, we're streaming in Facebook, and we are streaming in our own closed coaching community. Now, of course, people that access us through YouTube or Facebook are accessing the sessions for free. And we want it to be that way. We want people to be able to understand the markets and understand how to use the technology in the most accessible way possible. However, of course, there are those that pay to be within our closed coaching community. The difference between those two is that the people within our closed coaching community have access to more of our time in that closed environment. So what that means is at some point during the session, we cut off the stream that is going public, the stream that is going to YouTube and Facebook, and we continue in our closed coaching community just for the people within that. So we'll normally look at a trade together in public, and then after we found at least one trade, we'll stop the stream and continue looking for other trades after that. So that's how it works. Now, normally what we'll do is we'll go through the market environment, any trades that are closed, any trades that may be open that we might need to manage, and then we'll look for new opportunities. Sometimes we'll digress if somebody has a particular question on something, and we'll go into a particular topic, but of course here to help. Whatever you guys need ultimately is what we're going to be doing. So first things first, what I want to look at is the trades that we put on last time. So this was a trade that we put on, it was Match Group. This was a short trade. So the way we do this is our black line was our entry, our red line was our stop, so this was a short, and we had a target here on this green line, and then if we just squish this a bit more, we should be able to see, there we go. So we had a target here and a target here. Now what we see obviously is that price came through and stopped us out. Moved back a little bit in our favour, but would have gone quite far against us. Again, that's why it's good to have a stop and get out when we need to get out. If we're wrong, we're wrong, we get out and we save the rest of our money, rather than being in this position for however long, losing more and more and more. So that's why we manage our risk. So this was a losing trade from one that we put on last time. And that's fine, we know that this happens. Now, another trade that we put on was Facebook. So there we go. So this one, so far, what would have happened with this is we would have hit our safety target. So price would have come in around about here, moved away in our favor, and it's actually done that a couple of times, right? 3 times. so far come into our area and moved in our favor, so that's good. We would have at least been break even for this trade. Now, we see here with this note, and if I move it out of the way of price, we can see that bit there. Our final target was a trailing stop for Facebook. So what that means is that as new UFOs would have been formed, we would have moved our stop loss with that. So let's say, for example, price came in here, moved up, hit our safety target there, great. Came back down, came up, came back down, came up. Let's say, by the looks of it, just understanding what price patterns look like, probably around about here, a new UFO was formed. So we would have moved our stop loss from here to just beyond this UFO. And what that means is if price came back down, which it did, we would have got stopped out at this point. So what that means is we would have made half of our position here, and then just less than half of our position here. So overall, it might have been like a 0.8 to 1 or something into profit. Now, that depends on how actively you manage it. So if you just set and forgot, it doesn't sound as good there to do it in past tense, but if you did a set and forget trade, then of course price would have come in, hit your safety target, come back, come back, come back, come back, come back. At the moment, we'd still be in the trade. However, what we notice here is that at some point during our trade, this would have been yesterday, the climate changed. Now, because the climate changed, again, you might be checking on it on a daily basis. If the climate changes, you get out, which means, let's say yesterday, which was the 17th, let's say yesterday you looked at it at around, I'm going to assume, you looked at it, there you go, as the market opened. So if you looked at it at this point, where price was here, pretty much, then again you might have chosen to close that trade whilst it was open because the climate changed. It was no longer an upwards climate, and so you get out of that trade. If you didn't do either of those things, you didn't trail out at a UFO, or you didn't check in that the climate had changed, then you would still be in this trade waiting to see what happens with it. We have a confirmed upwards climate again now, so either we could go off, collect more profits on the way up, or it could come against us and we would get stopped out. If you managed your trades in either of the ways that I just explained, then you would come out of this entire trade already, and you would have been at a slight profit. So hopefully that makes sense. Let me know if you have any questions on that in the chat box. So that was Facebook. Now, before we look at new opportunities, what I want to do here is just come to the FX Street economic calendar. Here we go. Let's close that. And see about news that we have coming up. Now, let's just filter this so that we see, oh, that's not what I meant. Time we want from today to next week, because we're going to be, oh no, it'll be from here to here. We're going to be looking at swing trading opportunities, so we want to know what's coming up in the next week or so. And I'm going to filter it by just US. And I'm also going to filter it by only high impact, and then apply the filter. What this has done, well, it actually shows us that we don't have any high impact news coming out, although by the looks of it, that's not given us a full week. So let's try that again. There we go. So we have high impact news coming out on US markets, 6 o'clock. This is GMT time, so actually an hour behind the UK at the moment. So 6 o'clock, so let's say that's New York time, that would be 2 p.m. on Tuesday next week, and on Thursday next week as well we have a series of news articles coming out. Now, we don't care necessarily what those articles say. We don't care whether they're going to tell us that the markets go up or down, because if all you needed to do to be right on trades was wait for the news to come out and do what they told us to do, then everybody would make money in the markets. So we don't try and make subjective interpretations of the news. We look purely at technology. We're using this to let us know, hey, there may be some volatility on these days and on these times. And then you might choose to step away for an hour or so, let the news do what it's going to do, and then come back into the markets once things settle down. You may be somebody that loves volatility and you're waiting for it, and that's when you're going to choose to get in. But at least you'll know when there's likely to be volatility by using this calendar. So I've just seen a question come in there from Christian. Let me just read that. So wouldn't you want to wait for a thick red dot before you get out? Okay, good question. So that's if we come back to our Facebook Facebook trade. So this particular, I'm just going to freeze the screen there so we've got this highlighted. Yesterday, when this was a thin red dot, what that told us is that the climate was no longer confirmed either way. So even though it wasn't a thick red dot, which would tell us that the climate was confirmed down, it's telling us it's not up anymore. Now the only reason we would ever get into a trade to the upside is if the climate was thick blue, was probability upwards. If it's changing to anything other than thick blue, then it's telling us it's no longer got probability to the upside. So again, like with everything, you can mold the rules depending on how you feel about things, about risk versus probability versus reward. But for us, it's if we're going to only get into an upwards trade because we have upwards probability, then we will get out of a trade if we no longer have upwards probability, whatever that means, whether it means we have downwards probability, or in this case it was unconfirmed, didn't really know what it was doing kind of probability. Now, you could be somebody that has a rule that says I will stay in a trade unless or until the climate confirms itself to the other side. In doing that, you have pros and cons. So I'll just expand and explain on this, and I'll do this a lot in my sessions to tell you what the pros and cons are of different rules so that you can understand what one suits you best. I've explained what our rule is, but that doesn't necessarily mean it's 100% the best rule for everybody if you think about probability and risk in a different way. So let's say your rule was, if it changes to anything other than thick blue, I get out. Well, that would mean, like we explained before, you'd probably have got out around about this price, and you would have taken your safety target and then another target here, and you would have overall probably made about 0.8 to 1 or 0.9 to 1, something like that. A very small profit, but you'd be in profit. Now, you do that just in case, because this change to an unconfirmed climate no longer knows what it's doing, doesn't have probability upwards anymore, then you run the risk then of price coming against you. So better to have got out here when the climate was not sure what it was doing than to let it be unsure and perhaps come against you. So you're locking in smaller amounts of profit. The negative side of that is kind of like what it's just done. Perhaps it reconfirms itself to the upside. And if it reconfirms itself to the upside and you got out of a trade here, well, perhaps it shoots off like that and you've missed the entire move to the upside. So pros and cons. By getting out at a stricter, in a stricter environment, you protect yourself from potential downside, but you may miss out on potential upside. By having a rule that says you would only get out if it confirmed itself the other way, then you might end up with a series of unconfirmed dots, a series of unconfirmed climates, and price kind of does this, and you get stopped out because it's got no longer pressure to the upside, no longer probability to the upside. So you'd be opening yourself up to perhaps have a losing trade. But you would potentially be staying in if it kind of dillied about for a little bit and then shut up. So hopefully those pros and cons make sense as to why you might do one and why you might do the other. For us, it's probability upwards is the only reason we'd be in a trade, which means it's the only reason we'd stay in a trade. But like I said, pros and cons. If you got out on this candle round about here, you locked in a little bit of profit, we may be missing out on further to the upside, but you might have saved yourself from losing some money. So hopefully that makes sense. Looking back to April, the red dots were entry points in this case. Should one look back in the climate chart? So yes, let's have a look back here. So this was May, these thick red dots, and here we have end of April, these were thin red dots. So because they're thin, let me just try and highlight them. My mouse is being a little bit strange at the moment. Maybe I can do it like that. There you go. Cool. So these thin red dots would be telling us that we don't have enough probability either way. So again, it's unconfirmed. It's not really sure what it's doing. And if it's not sure what it's doing, we'd rather keep away. Because if it's not sure, then it could shoot up, it could shoot down. We don't have any probabilities or statistics to tell us one way or the other. Which is why we would choose to only get in when we have thick blue dots to the upside or thick red dots to the downside. So let's say, for example, here, this first thick blue dot meaning we would get in on this candle. That would be a good time to get in because it shot up from there. If we had this red dot, then we got in on this candle at the start of this candle. 1, 2, 3, yep. No, perhaps, wondering how that's working out. There you go. So we'd get in here, perhaps we would have made a little bit to the downside, but of course it then confirmed itself upwards. But we want to get in where we have confirmation. Getting in around here with these thin dots might mean that we either bought or sold, wouldn't know which one to do. We could have bought here and done well out of it by luck. We could have sold here and done badly out of it by bad luck. It kind of opens it up to being more based on luck and less based on statistics. If we take here again, for example, this thick blue dot that we have here on our climate, that corresponds with this candle, which means we would have got in around about here, which would have been a good place to get in because price went up from that point. So we only ever want to get into a trade when we have a thick dot of either colour. So thick blue, we look to get into a buy opportunity. Thick red, we look to get into a sell opportunity. If it's a thin dot of either colour, ignore it, move on to a different stock or maybe change time frames. So hopefully that makes sense as to why we do that and how that works. But I'll keep my eye on the chat box in case you have any follow-up questions to that. So, whilst you might have questions to that, whilst you're doing that, let's have a look here at the potential opportunities that we may have. I'm just going to run the scan. I did already run the scan and it's come back with nothing, so I'm going to run it again just whilst we talk about some other things. So we knew from our look into, let's bring this up, the economic calendar, that we won't have high impact news on the US dollar until maybe Tuesday, so we can keep an eye on it Tuesday sort of afternoon US time, but otherwise we have a bit of a clear run for a few days, which is great. Now what I've done here is I've come and looked at the ES. The ES is the futures contract that represents the S&P, and the S&P 500 are the top 500 US stocks. Now why do we care about that? We're not necessarily trading the ETFs of these things, although we can look into them. Because if we're looking at stocks, most of the stocks that we would look at are within the S&P, i.e. they're one of the top 500 stocks in the US. So if the S&P as a whole, if the basket as a whole, the index as a whole is on its way down, which it is for example here, on a daily chart we have a thick red dot, probability downwards. So if the entire market is on its way down for the last couple of days, then buying individual stocks within it means we might be fighting against the tide a little bit. Now, ultimately what matters is what each individual stock has in terms of its probability. If we look at a stock and it has amazing probability upwards and the EMA lines up and the UFOs line up, the fact that it doesn't correlate with the market as a whole is not necessarily going to switch us off to placing that trade. But for me, I would rather place my time initially looking at trades that are correlated with what the entire market is doing. If the entire market is on its way down, then it makes sense for us to be getting into stocks that are also on their way down, because the index pulls the stock down and the stock pulls the index down. So if we can get stocks that correlate with the market average, then great, it gives us slightly more probability there. Now I'm running a stock here for the downside, or running a scan here for the downside, because again it makes more sense to look at stocks that align with what the overall market is doing. But we can also run a scan to the upside as well and see if we have any opportunities there. Now before we do that, as we know we have probability down with the S&P, we could take a look at one of the ETFs. We could take a look at the SPY and see if we have any opportunities there. I know last time I had a question to say why don't we look at ETFs, and the main reason for that is because there's only stocks in the scans that we look at, and we tend to use the scans, but there's obviously absolutely nothing wrong with looking at ETFs themselves. Now from the looks of it, I can't see any UFOs on this particular market, so let's, well, it should be 500 bars back, should be our default, so let's load a bit more data there. There we go. Okay, so first things first, we're unlikely to have an opportunity here because it looks like we have no sell orders above us. Now perhaps if we just go to edit studies and we customize our UFOs, perhaps if we were to change our calibration just to see that. There you go. Okay, so with changing our calibration, we've managed to see some sell orders here. Now, if you don't understand calibration or what I just did, we have loads of videos. They tend to be sharpening sessions where we expand on calibration. The standard calibration that we use is 0.5 for all of the sessions that we do, but a few of us will use 0.618 as our personal calibrations. Some people will use different numbers as well. Essentially what calibration does is it makes the app more or less sensitive to UFOs. And again, pros and cons with that. If it's less sensitive to UFOs, meaning it's less likely to bring them up, then the ones that it does bring up are going to be more probable, because they're going to have to hit more of the criteria in order to show up, which means if they're showing up, they have more probability usually. If it's more sensitive, so it's picking up even smaller cues, then it's going to show us more opportunities, but perhaps those opportunities have slightly less probability because it's got to hit less criteria for it to show up, if that makes sense. Again, you can check videos on the sharpening sessions that we do about calibration, and hopefully that makes a bit of sense. But whilst we're here, we'll have a look at a potential opportunity that we have here, and by the looks of it, we do. So, one of the beauties with ETFs, for those that might not know, ETF stands for Exchange Traded Fund. Essentially what it means is you will buy and sell shares of a fund that itself is invested in all of the shares, or all of the different stocks, essentially. So what this means is, if we bought the SPY, then by buying one share of the SPY, we would essentially be buying one share of each of the top 500 US stocks, because we're buying a representation of all of them. If we sell the SPY, then we are selling all of the stocks in the S&P 500, or we're selling a representation of that. So, considering we have probability downwards, we know that the market as a whole has probability downwards. Oh, there we go, our scans just come back with one potential individual stock opportunity there, so we'll look at that in a second. But we'll start with this one. So, thick red dot there, probability down. We have UFOs here, great. If we're going to sell, we want to sell at red UFOs, our sell UFOs. Now, which one do we pick? This is where our EMA value comes in. So this is the methodology that we run through. If you're completely new to this and you're watching this video for the first time, don't worry if you're not catching up with all of the different elements of the methodology. There's loads and loads of videos which should help you to understand that more. I know for the people that I can see in the room today, these are people that would have joined us a few times before, so you know what I mean when I'm saying that things are lining up. Let me know though on the chat box if there is any confusion. So, our EMA value is 421.47. You know what I'm going to do? I'm just going to take this random line that I've drawn here, and we're going to go 421.47. There we go. Now we actually put some trades on the SPY last time, so we'll have a look at how that panned out as well once we go back to trading view. But looking at this one, we have the EMA value is within this UFO. So what that means is we have sell orders coming in here from the UFO and sell orders that are going to come in here from the EMA. Sell orders plus sell orders in the context of a downwards climate tells us a lot of probability down around that area, so that's where we're going to sell it. This is why we use technology to do a lot of the work for us. It's telling us these things are lining up, you've got probability. If they don't line up, we don't have probability, we don't trade. It becomes a really easy yes or no question most of the time. We're not having to think about it really, or interpret anything, or be subjective about anything. It's all based on the software, the technology itself. So what we're going to do, we're going to move across to TradingView, because I know people use different platforms. So we'll move across to TradingView. We'll look at the SPY. So here, for example, by the way, this was a trade that we put on last time, and just before we put on this new one, let's have a quick look at what would have happened here. So we put the trade on round about this point, right, round about here when we put our trade on. Price moved away and didn't come back for quite a while. By the time it came back, so round about this point, if we hover our mouse over here, at this point we had a thick red dot, which means we would have cancelled this trade. So it looks like price moved through this trade, but we would never have placed it. We would have cancelled it by the time it ever got to entry. Even this one here, which is where price actually dropped down, you might not see that very well, but price dropped down, wicked in, and then actually shot up. We would have actually made a profit on that one, but we wouldn't have got into it either, because at this point the climate was unconfirmed. So if the climate's unconfirmed, then we would have cancelled that trade. So again, for the reasons that we talked about earlier. So this trade would have been cancelled, we wouldn't have placed it anyway. So looking at our new opportunity, we had, let me just change my calibration, or it is already at that calibration. So it was this UFO here that we're using. So I'm going to place this trade and explain to you all of the different components for it. I'll do that the other way around. And then we'll cut the stream and continue in the closed coaching session. So I've just drawn Fibonacci lines around this. I do not use Fibonacci how they're intended. I use them as a drawing tool. So if you do use Fibonacci and you're looking at this thinking, what is she doing? Just understand, I use it as a drawing tool. I don't use Fibonacci as an indicator by itself. And so I just use it to help highlight areas, make it a bit easier for me visually. So what we're going to do, I've just drawn those random lines. I'm going to double click on them so I can be much more specific now about where those numbers are going to be. So what these numbers are, these are going to be my entry and my stop. I'm going to go short on the SPY, which means I'm going to want an entry, stop, and ideally 2 targets. So first things first, our entry is going to be using this bottom number that the UFO has given us. The UFO is telling us there that our entry should be 419.22. Great. Now our stop loss, we have this number, this top number on the UFO here, 422.60. So what we're going to do is type in 422.60, but I'm actually going to add 10 cents worth of wiggle room there. So it's 422.70. Click OK. And now those lines, they've moved a little bit, but if you were paying attention, you would have seen they've moved and they've now been lined up exactly with what the UFO was telling us and where we got those numbers from. So I've just seen a question there from Joe. Good question, Joe. I will get back to you on that in just a second once we've put this first trade on. Okay, so this is our entry and stop. The black line is our entry at the start of this stack of sell orders. The red line is our stop at the back of that stack of sell orders. And as you can see here over on the other side, very clearly our EMA coincides with it, so brilliant. Now, where's our first target going to be? Now, first target, very easy, it's just 1 to 1 away. It's really, really easy to calculate. So we're just going to type in our entry and our stop loss, 419.22. Oh, 422, sorry. 422.70, that's our stop loss. And that's now told us that in pips, meaning the smallest increment of price, at 348 pips. So 348 cents is what we're risking between those two numbers. So if we want our target to be 1 to 1 away, we just click take profit and type in 348. That's it. TradingView does most of the maths for us, we don't need to figure it out. You'll see then this number says 1, which is telling us that's 1 to 1 away. Now last thing before we put this first one on is we want $50 risk. Now I'm saying $50 risk just because I'm assuming that the total risk that we're going to have here is $100, so we'll put $50 on one target and $50 on another target. That's only because I'm using $100 as a nice round number. It's easy to do the maths on. You guys are going to have different numbers. It's going to be a percentage of your account. You might risk $5,000 per trade. You might risk $5 per trade. You might risk anything in between or above or below. Ultimately, your risk is entirely subjective, and so it should be. Somebody with a bigger or smaller account, of course, is going to trade bigger or smaller sizes when they place their trades. So for this example, I'm assuming $100 total, $50 on one, $50 on another. So we'll double check that we've got the numbers right. 419.22, that's our entry. 422.70, that's our stop loss. Great. 415.74 now is going to be our safety target. I'm going to draw it on the chart just so we've got a nice, easy visual to come back to at a later date and see what happened. And again, I'll just draw the line, double click on it so I can type over it and get it exactly where it needs to be. So that will be our safety target. And then we'll just click sell. So that's gone in. Now you might be thinking, okay, well, great if it moves 1 to 1 away, we'll make a little bit, but what about this other target? This is where we're going to come back to a slightly bigger time frame here, which is our daily chart, and we're going to look at this stack of buy orders. This is going to be where we get out if we're right and it continues down for quite a way. So the number for that is 398 exactly. So I'm just going to draw that on the chart again, just so it's nice and easy to see. Double click, 398. That is going to be our final target. Now we're doing that because if we have a confirmed downwards climate and we have sell orders coming in and we have sell orders coming in from the EMA, the only thing that can stop those sell orders are buy orders. Now there might be a situation where new buy orders come into the market, and we'll manage that if that happens, but for the time being the closest stack of buy orders we have on the bigger time frame is down here. So that's where our second target goes. So we will put in the same thing again. So 419.22, that's our entry. Our stop loss is the same, and it's remembered it. Our profit, instead of typing in pips this time, what we're going to do is type in the price, which is 398. And again, we're going to risk $50 with that. Double check that we've got all the numbers right. 419.22 for the entry, 422.70 for the stop loss, and 398 there for our target. And you can see here, this part of the trade is a 6 to 1. So if we've got a, well, 6.1 to 1. So if we have a 6 to 1 and we have a 1 to 1, and we're right on both, then overall it should average out about 3.5, 4-ish to 1. Okay, and then we'll click sell. So that is the first trade that we've put on. What I'll do now, I'll address the question that Joe that you put in the chat box there. I'll address that question, and then we'll cut the stream and continue to look for new opportunities in our closed environment. So the question was, do you utilize a percentage threshold for considering a UFO? The short answer to that is yes. So for example, these blue figures here that come in on our percentages, these tell us the likelihood that price moves between UFOs on that time frame. So I know UFOs are reasonably far apart on this time frame here, but what this tells us is that 47.96% of the time price moves between UFOs. UFOs could be really close together, they could be really far away. That's not necessarily telling us how much money we make. If 47% of the time it was hitting 10 to 1s, you'd make a lot of money. If 47% of the time it was hitting 1 to 1s, then you'd just slightly be losing money. So it's not necessarily telling us how much money we make or how well we would do, but normally the higher this number, the more probability is that your trade's going to work out. So for me, my rule is 40%, because 40%, if I average out my trades at 2 to 1, that's still profitable, and I'm happy with that. Other people might say I want that number to be 60, 70, 80%. Great, and you can do that. Understand that the higher your threshold, the less trading opportunity you have. And even if it was 90%, but it meant that UFOs were this close together, and 90% of the time price went here to here, you still wouldn't make very much money. So it's not, like I said, it's not necessarily reflective of your overall profitability, but in general, if it has higher probability of working out, then great. So for me, that number is 40%, 40. But again, that's me personally, and I'm happy with that based on my risk tolerance and how I feel about probability. You may be somebody that wants that number to be higher, and that's fine. Don't take 40% just because I do it. Ultimately, you've got to do something that's comfortable to you. If you're right 40% of the time, roughly, then you're wrong 60% of the time. And for some people, they won't be able to handle that. For some people, they say, well, if my targets are far away, then I'm fine if that number's 20%. Because even if I'm only right 20% of the time, if when I'm right, I make 20 times what I lose when I'm wrong, then I'm still making a lot of money. So fine with that. Now, what's good about this number is this is your absolute foundation, the absolute basic. Because if you are, sorry, I just saw a question there from Christian, I'll check that in a second. If you are selling in the context of a downwards climate, then that increases the probability that these sell orders work, and it decreases the probability that the buy orders work. So this UFO doesn't necessarily have only 47% probability. That 47% probability is just price moving between UFOs, which could happen at any time, in any context. So So add in context of a downwards climate and you add probability. Add in context of our EMA number and you add probability. So the good thing about that number that we have here is the absolute minimum. So for me, 40% is, I'm happy with that, but ultimately you guys will figure out which numbers work best for you. So just seeing a question there from Christian, using the 60-minute time frame. So on TradingView it was 55 minutes, but perhaps I didn't check when we moved to, sorry, TradeStation was 55. Oh, on TradingView it's 55 as well. So you could use a 60-minute time frame if you want to, there's nothing wrong with that. On a lot of platforms they wouldn't even let you see a 55-minute, so that's fine. But you'll notice up here we have 55-minute up there, and we have 55-minute on our TradeStation chart as well. Now the reason we use 55 minutes is because it gives us sort of slightly better odds a lot of the time, not always, but most of the time the Fibonacci denominated timeframes give us a little bit more probability than just the standard timeframes. Hence why we use 55 rather than 60. So we have placed one trade, we've gone short on the SPY, which is our ETF here. What we'll do when we continue in the closed coaching session in a minute is we will look through some new opportunities, and we'll also look at some of the other ETFs that we placed last time and see what happened with those. I will cut the stream now to YouTube and Facebook. So give me a sec, sometimes it takes a minute to get this done. So for those of you that have been watching on YouTube and Facebook, hopefully so far this has been helpful for you. You've got a trade that we've placed there, and hopefully you understand why we placed that trade. If you have any questions, you can email me, becky@tradictive.com, or there's tradewithufos.com/Becky, and you can get hold of me there by posting a question down here, and I will answer it in public so everybody else can see the answer. So what I'll do is I'll cut the stream now. So I'll see you guys that are joining us on YouTube and Facebook. I'll see you next time. I'll be back on Monday morning, so I'll see you then. And for those of you in the closed coaching room, give me a second whilst I switch all this off, and then we'll continue in there.